just before you are freezing. So in the case of insurance, there is the entire third chapter about this, so let's go through everything. So what is relevant for us in the future? Obviously there is a protection against adverse events, and there is a policyholder who pays a regular premium, and after that, if unfortunate things are happening, which are defined in the contract, then he or she or the company will receive a payment if the certain specified event happens. And after that we have the practically two main ways of insurance: life insurance and property-casualty insurance. So in the case of life insurance, it's quite simple. Long-term policyholder dies, it will pay sometimes. In the case of property-casualty, it's usually runs out in a year, or it's much more short-term than the long-term one. So it provides some compensation also in a specified events, so accident, fire, and so on. And usually they are independent events. And this property casualty can be divided to three parts: property, health, and casualty. Okay, so how can we earn money here, and what kind of risk can we identify? So first of all, we can have different setups in the case of life insurance. So we can have an annuity thing that right now we can have regular payments until someone dies, and in this case there is a lump sum money. Just in this case the ordering is different. So right now we get the money, or we put the money inside the insurance company, and after that we get payments until we get this. And practically this is quite an old one. So even oh, there was this stupid French book. I hated it so much. I don't like French literature that much. I forgot the Hungarian name as well. Okay, whatever. So I know that the old guy is always so we have to always cover the families and relatives' payments, and he's always selling his annuity and takes out money and takes a smaller annuity. So practically this is how he is able to mobilize his funds. And we can see that it already existed in the era of Balzac, so we can say that okay, it's at least 200 years old contract, what we can see, or nearly 300. Okay, endowment is much more happier, because not just in the case of death, but also in the case of expiration. So if someone is able to survive for some time period, then they get the money. And also sometimes there is a term contract, so it says that if there is an underlying mortgage, then if the debtor dies, then it will be paid. Unfortunately, I don't have such contract, so yeah, it's sad. Also, there is the classical way, so the whole life contract that so the payout is certain, just we have no idea about the timing, so that's why premiums can be bigger, so the payments can be higher. But this is when the funny part starts, because these variable lives or universal lives can have an investment component. So not just you are paying for the insurance, but also you have the premium contains some extra payment, and this money will be invested into a mortgage, or sorry, into other assets like bonds, mortgages, and so on, money market funds, and it can be mobilized in the case of death or in the case of someone reaches some predefined time period. So after that, it can be act as a long-term investment vehicle as well. And this is where investment funds or investment banks or hedge funds or mutual funds can earn a lot of money, because this is practically generates them a stable investment base or investor base, because okay, you can sell, so you can mobilize also this kind of funds, but usually also states are supporting this with tax benefits. In Hungary, sometimes they are removing it, sometimes they are giving it back. So right now we have this. It depends that the state needs the money or not that much, and after that, it's much better than if you have just much more liquid or jumpy investors. Okay, if you are looking on the other side, then we can see that, okay, casualty, it's always related to some kind of liability or legal exposures, and the problem is that maybe right now we were able to assess the risk of the company, but after that something happens years later, and it can backfire for the premium payer. Also, we can have the property, and in this case we can see that catastrophe bonds are existing in some markets, especially in the US. And why it's good to have this? Because they don't have systemic risk. So this is what you can use for diversifying a portfolio, because in this case practically catastrophes are happening quite randomly and quite so their appearance in the distribution, it's quite extreme, so it's quite unique. And higher yields are paid, so that's why you have to be compensated, because the bondholder pays if the risk happens. So it's quite an opposite form of investment. So it's much more like catastrophe bond is much more like reinsurance than a classical bond holding. Okay, health. It's also tricky, because here we have regular revenues, and the payout will be triggered by something which is happening by the client. So hospital treatment, prescribed medication, or just do you need an MRI checkout, or you are going to the dentist. So it can be have different levels and layers. Just still, the cash flows are much more irregular than in the other cases. So it can come and go. And still, it's really interesting that I have also health insurance, but mostly I have this mixed thing. So I'm paying a sum which will just accumulate it. So I can use this money up if I need this, but it's not insurance related, but also has some kind of insurance which I never used, to be honest. But how can we deal with this? Because in the insurance contracts it's written that, okay, if I need MRI services then for diagnostics, then I can use these funds. But practically I completely forgot about last time, and I used my own money to have this. Yeah, and I'm an economist. Okay, so if you are going to reinsurance, practically we can see that this is where they are trying to diversify it further. So some of the premium or inflowing premiums to the insurance company will be redistributed to other reinsurance firms, and in this case they will be able to participate also in the risk taking. So until there is no catastrophe event or financial crisis, then usually reinsurance companies are quite lucrative. The problem is that we cannot see here partner risk, because insurance companies, and one of the major insurance companies in the US was also trying to deal with credit default obligations and swaps in the US during the 2000s, and that's why this company had to be bailed out by the US government, because they started to lose a lot of money on the CDO CDS market. So because they were saying that, oh, it's a CDS is like an insurance, because because we have some revenues which are flowing in, then we have a default when we have to pay, so it behaves like the same way. Just no, it's not, because there is a spillover effect, and CDSs or CDOs are executed at the same time usually if there is a recession, and this is what they were able to forget to understand. So yeah. Okay, and what are the problems? So moral hazard. So the client can have completely different behavior. They will be less cautious. Maybe they don't care about as much as there has before, because now they have some insurance, and they will be also more risk takers because they think that they are covered. And that's why they have this deductible co-payment from the policyholder. So you are never insured against 100% of the value of the asset. Usually it's a bit lower, because otherwise moral hazard would be too high. And adverse selection, so you can distinguish bad and good risk. So if it would be not managed by co-payment, then what would happen? That insurance fees would be way bigger, and also they would try to filter out clients in an inefficient way. So yeah. Okay, and how can we deal with this kind of risk? So first of all, capital requirements are also visible in this industry, so not just in the banking system. And we can see that Solvency I capital is all the policy provision. Just in this case, it's not 8%. Yes, I forgot the story about the 8%. So 8% is because during past bank crisis situations, during the 80s and 70s, if banks were able to survive, if they would have 8% of the overall debt, and after that they kept this. But you can see during the 2008 crisis, or after the 2008 crisis, supervision authorities were always increasing the capital reserve ratio, or required capital reserve ratio, above 10%. So sometimes even it was 12%, because they were running stress tests and they realized that maybe the 8% is not or could not be enough. And we can see it here. So this 4% is just the lowest minimum level. So it can be higher if the supervision agencies realizes that, okay, now the risk or potential for risk is higher. So, but I don't know what is happening in the case of life insurance. Okay, in the property casualty, maybe we can have some data, but here there was a PhD thesis which I was the reviewer, one of the reviewers. It was written by a guy at the mathematics department at the Debrecen University, and practically he was forecasting life expectancy and death probability with neural networks. So this is where I was able to collect some of my knowledge at the level of neural network forecasting, because all these methods, how you can deal with the... Oh, come on. So if you are able to deal with the memory of the model, with reluctant models, then you can have better forecasts. But obviously we were trolling him sometimes because we were asking that, okay, but how COVID deaths can be added to the game? And in this case, obviously he was not able to forecast this because it was an external or exogenous shock. So, but in this case, for example, solvency ratio can be increased by the agency because the state can realize, because they have all the data, that okay, that number is increasing because some kind of epidemic. So in this case, it can be reasonable to say that now they should increase the capital. So please, owners, put some money, fresh money into the bank or into the insurance company. Yeah. Okay. So in the case of the asset side of the life insurance company, we can say that in many cases, corporate bond, it's a typo. So corporate bond invested at similar maturity, but if companies have issues because, okay, corporate bond has higher yields, so obviously that's the key motivation behind this. Just in this case, you are also subject of partner risk. So what happens if they are going down, or what happens if the value of the corporate bond decreases? Because if yields are going up, right, in the current environment, obviously bond prices will go down. So we can see that the asset side of the insurance company start to shrink because of this effect. So even a significant change in the partner is just in the change of the yield curve. They can be adversely affected. And in the case of liabilities, so policy reserves can be affected if people are dying earlier and they are not a good payer of the premiums. So it can be another problem. So mortality ratio and longevity ratio can be a problem as well, because if you are paying annuity, then it's a bad thing for us. How dare they live longer? So that's why usually they have longevity bonds, which means that they are also issuing bonds to cover this kind of thing. And it's also good because they don't have systemic risk as an investment. And okay, investment performance, I mentioned already, partner risk. Yeah, so reinsurance can be another thing, but usually reinsurance companies, I remember only that some of them had to be built out during 2008, but it was, again, it was CDS related, not classical insurance related. Okay, ratios. So the book defines different ratios for us. So there is a loss ratio, which says that, okay, payouts made and premiums earned, and they're supposed to be somewhere between 60 to 80% to have a healthy insurance company. Then expense ratio, where you can find all the expenses, so losses and commission or sales related expenses like commission, acquisition, and so on. So what we have to pay for the agents. There is no threshold for that one, just we can calculate it. Also, we can have the combined loss and expense ratio after dividend, and then we can have the operating ratio, so all the investment incomes and the premiums what we earned. Because at the end of the day, we know that what we can earn on the investment side, so on the asset side, it still will be kept by the insurance company. So if we are able to play well with the asset side portfolio, then this is what we can earn. Okay, we can combine these unit-linked contracts when also we are sharing some part of these revenues with the client, but otherwise it's a nice thing. So usually changes in the yield curve, especially increases of interest rates, are not that great news for these companies because it's affecting badly their